Your retirement fund is betting against you. Your 401k just raised your rent. Alicia's renewal hit her inbox at 6:12 p.m., up 12%, plus a new $35 valet trash fee. At 9:30, she checked her retirement portal. Top Holding, the company that owns her building's parent. Her insurer premiums rose too. Her statement praised defensive returns. Her grocery bill didn't. After taxes, fees, and price hikes, her household was down $4,380 versus what her portfolio made. That gap isn't a glitch. It's the business model of modern retirement. Your savings own the system that charges you. To see how that happened, we have to follow the money. Out of her paycheck and back to her kitchen. Follow the money. How your savings become your opponent. It starts on payday. A slice of Alicia's wages auto-defers into the plan her employer picked years ago. The record keeper routes it to a default target date fund. The dashboard looks tidy: glide path, diversification, reassurance. Meanwhile, the dollars pass through wrappers into index sleeves that own the companies setting her bills this month. The holdings aren't safety. They're stakes in real estate platforms that manage her apartment, insurers and pharmacy middlemen that price her premiums, consumer staples giants that engineer price realization, farmland and processors upstream of the cereal box, and corporate bonds those firms issue, so her bond sleeve clips coupons while those issuers preserve margins. Stakes first. This is rent that decides school districts, deductibles that decide whether a scan happens, and a grocery receipt that decides what goes back on the shelf. For Alicia, the math isn't quarterly, it's Thursday night. Action. Her contributions feed target date funds anchored in low-cost index sleeves. Those sleeves concentrate voting power in a handful of asset managers that sit atop rival landlords, rival insurers, and rival brands. Nobody needs to conspire when ownership overlaps encourage rational pricing. Across town, the same complexes collect fees for plan administration, for advice overlays, and inside funds for securities lending splits. The plan literature sells broad diversification. The portfolio companies sell same-store NOI growth, pricing discipline, and margin expansion. Impact. Diversification dampens single-company risk, but it can neutralize the competition that would have lowered her bills. She gets the market return and the market's bill. Her household cash flow pays the defensive premium while her future self waits for compounding she can't touch. To understand why, go back to auto-enrollment. Employers embraced it to help people save. Participation soared. Therefore, money pooled in defaults. Target date funds built from index components. Therefore, a small set of managers became top owners across sectors. Therefore, stewardship teams, competing on thin fees, engaged politely while defending industry stability that kept redemptions low. The plan solved inertia and created concentration. Housing makes it vivid. The same retirement complex owns REITs and backs private platforms that buy clusters of apartments and single-family homes. At renewal, software sets dynamic increases. Slide decks call it value add and discipline. Alicia calls it moving farther out or paying to stay. The dividend in her plan is a few hundred. The rent delta is a few thousand. The ledger doesn't balance. Healthcare tightens the vice. Insurers integrate with PBMs and specialty pharmacies. Rebates tied to list prices create spreads. Facility fees reclassify ordinary visits. Employers push cost sharing to tame premiums. The insurer stock in Alicia's fund pays dividends. The bond sleeve holds the debt they use to finance buybacks. Her out-of-pocket climbs anyway. Food adds the daily drumbeat. Pension-backed farmland funds bid up acreage, raising lease costs. Input suppliers defend pricing with IP. Processors protect spread with mix. Brands shrink packs and standardize promotions. Retailers bank the lag when commodities fall. Her staples ETF celebrates resilience. Her cart total proves it. But there's one problem the glossy brochures skip. The household is the counterparty. For defensive returns to look stable, someone must pay more often, more predictably. That someone is the same saver whose contributions fund the ownership. Let's pin names to incentives. Asset managers get paid on assets. Record keepers get paid on headcount and features. Plan sponsors prefer low headline fees and simple defaults. Portfolio companies want pricing power. Stewardship prefers stability. Alicia wants lower bills and decent returns. Only one player lives with her checkout total. What nobody sees from the portal is how low cost still means high ownership of her cost of living. Expense ratios fell. Ownership concentration rose. Stewardship talks about disclosure. Fee wars discourage aggressive votes that would threaten margins in concentrated industries. Silence becomes a position. A microstory. Ben at Alicia's office clicks managed account, just 0.35%. His allocation ends up as the same core indexes plus an overlay. He pays plan admin, fund expenses, and the overlay fee, while his landlord raises rent and his insurer tightens formularies. Nothing looks egregious. Together, it's a siphon. Impact on compounding is brutal. 1 percentage point of all-in friction over decades is 6 figures gone. Meanwhile, bills rise now. Alicia lowers contributions to manage cash, which worsens sequence risk later because glide paths assume steady savings. Here's where the perspective flips. We usually treat saving and spending as separate worlds. They're the same ledger. The money flows into funds that own the firms that set her costs. The costs flow out in rent, premiums, and groceries. They meet at 9:30 p.m., when the portal shows green arrows and the budget shows red. Now remember, the tax benefits and matches are real. The answer isn't don't save. It's follow the incentives, then cut the tolls. She can demand clean shares so admin is visible in dollars, favor true low-cost cores over layered wrappers, and push her plan to publish an all-in fee. She can build a buffer so she doesn't pause contributions when the rent letter hits. And she can map her top holdings against her top household costs, so she knows where her money meets her bills. Housing capture. When your 401k owns your landlord. Start at the front door. A key turns, a lease renews, and somewhere a fund uploads a slide deck. The headline says stable cash yields. The footnotes list escalators and fees. Alicia's renewal wasn't a glitch. It was a plan with software behind it. Institutional landlords sit in 2 buckets your plan touches. Public REITs you can see in index funds, and private platforms you can't. Both run on scale. They buy clusters of single-family rentals and mid-market apartments, wire centralized leasing across metros, and let revenue managers adjust rents daily. Scale lowers vendor costs. It also narrows your options when you try to negotiate. Here's the incentive map. Leases lock annual increases. Property managers layer ancillary revenue. Application, admin, pet, package, valet trash, parking tech. Renovations, value add. Swap appliances, repaint, add keyless entry, then reset asking rents higher. Vacancy is a risk. Pricing discipline is a strategy. The target is simple. Grow same-store net operating income. The dividend shows up in your plan. The delta lands in your budget. Action in the wild. A tenant in Atlanta gets a renewal at plus 12% and a new $35 trash fee. The platform's earnings call highlights dynamic pricing and improved renewal spreads. In Phoenix, a multifamily roll-up renovates kitchens, raises asking rents 9%, trims on-site maintenance, and directs service requests through an app. The REIT supplement shows margin expansion. The hallway posts submit requests online. Impact. When platforms sweep up scattered homes or B-class apartments, small landlords sell or lose share. Fewer independent owners means fewer below-market renewals to anchor prices. Data-driven pricing isn't illegal, it's efficient. But when the same fund complexes are top holders across rival landlords, the urge to undercut softens. Common ownership prefers rational outcomes. Your retirement dollars help build the moat that now rings your neighborhood. What nobody sees until they click Look Through Holdings. The low-cost index owns most listed landlords in your city. Contributions buy more every paycheck, cementing top 3 ownership stakes. In the private sleeve, target date funds may allocate to real estate vehicles that own off-exchange housing platforms. Different wrappers, same streets. A microstory. Devin, a nurse in Tampa, calls to negotiate. The site manager reads from the screen. We price with market data. Devin points to 12 on-time payments. The system offers a one-time $150 loyalty credit if she signs today. She signs. Her commute stays, her rent doesn't. Stakes are monthly and after tax. A 10% renewal on $2,000 is $200 a month, $2, $400 a year, plus new fees. Covering that takes roughly $3,000 in pre-tax wages. The REIT yield inside a mid-5-figure sleeve might throw a few $100s. The defensive return doesn't defend her cash flow. Meanwhile, acquisitions continue. A private equity fund buys a 500-unit Sunbelt portfolio. The press release promises tech-enabled leasing and operational synergies. County assessors revalue properties, taxes pass through. Insurance premiums rise, they pass through too. Underwriting still pencils because the pro forma assumes steady rent growth and modest capex. Tenants underwrite the pro forma with their paychecks. Now add rates. When financing is floating, rising interest strengthens the urge to push rents. Renewal discipline becomes debt service. Your plan's bond sleeve may hold securitized slices of the loans. The same portfolio collects coupons while the operating company hunts spreads from residents. Alicia's math is blunt. Her renewal is plus 12%, plus a $35 fee. She tours a cheaper complex 15 miles away. Deposits, parking, and community tech narrow the gap. Her current place offers a save $500 if you sign today. She signs. The platform logs retention. Her account logs an ordinary income distribution. Her evenings log another year of driving the same route. What about supply fixing it? New building helps, after years. Zoning, rates, materials, and labor slow delivery. When supply lags demand, pricing software wins. If regulators cap increases, platforms lean on fees and amenity upgrades. If caps sunset, deferred hikes land fast. Stability for investors persists. Predictability for tenants doesn't. Let's bring a contested fact to the table. In San Diego, reporting from labor and tenant groups argued rent increases ran hotter at institutional portfolios than local averages. At the same time, large owners publicized satisfaction gains, capital improvements, and compliance with state caps. Both stories can be true. Better amenities and systems on one axis, higher renewal spreads on the other. Your 401k sits on the cap table either way. Human reactions tell the rest. Residents form tenant chats to decode fees. They track when to give notice to gain leverage. They share scripts, ask for a 2-year term with a smaller first-year bump, escalate to regional, request removal of add-on charges. Wins are modest, $50 here, a waived fee there, but they add up. The platform calls it targeted concessions. The spreadsheet calls it NER optimization. In the aftermath, investor letters celebrate same-store NOI plus 7%, turnover down 90 BPS, digital leasing adoption. Analysts ask if renewal spreads are sustainable. Management cites constrained supply and household formation. Index funds accumulate more by mandate. Participants keep funding the ownership that prices their lease. Not every landlord squeezes. Some invest heavily in upkeep and keep renewals fair to reduce turnover. The point isn't villains, it's design. When your retirement engine is rewarded for predictable rent growth at scale, the pressure shows up in your lease. If your roof costs more because your capital asked it to, the fix isn't a single fund switch. It starts with making the incentives visible, then cutting the tolls you control, and pushing your plan to publish the ones you don't. Healthcare inflation engine, pensions long, patients short. The envelope looks routine, open enrollment again. Alicia scans the grid, premium up 9%, deductible up $1,000, coinsurance higher on Tier 3 drugs. The newsletter in the same inbox praises her target date fund's defensive healthcare outperformance. 10 days later, her son twists an ankle. Urgent care is in-network. The radiologist isn't. 2 envelopes arrive. The math doesn't wait for investor day. Follow the ownership web. Her retirement dollars own the insurer that prices her premium, the PBM that designs the formulary and negotiates rebates, the specialty pharmacy that fills high-margin meds, hospital systems that apply facility fees to ordinary visits, device makers with opaque contracts, and distributors that take a cut per box. Pension funds and 401k are limited partners in Roll UPS of dermatology, anesthesia, dental, and rural hospitals. Growth stories lean less on more patients and more on higher allowed amounts per visit. Efficiency often means fewer rivals and more leverage in negotiations. Stakes first. Healthcare doesn't hit once, it stalks Tuesday nights. A $480 MRI that becomes $1,140 when a professional bill arrives. A $40 inhaler that jumps to $120 after a mid-year formulary refresh. Skipping a follow-up because you haven't met the deductible. It's not CPI, it's a decision in a pharmacy line with a kid who's wheezing. Action starts at the counter. The PBM sets tiers. Manufacturers pay rebates tied to list prices to stay preferred. Higher lists mean bigger rebates. Employers feel savings in quotes. Alicia pays co-insurance on an inflated anchor. Meanwhile, integration shuffles the spread in-house. The insurer owns the PBM and the specialty pharmacy. Complex drugs route to the house channel. Margins get reported as pharmacy services growth. On the hospital side, consolidation reflags clinics as outpatient departments, so identical procedures carry facility fees. A sprained ankle enters the coding labyrinth and leaves as revenue. Meanwhile, something else is happening on ballots. The index giants stewarding Alicia's shares publish principles, meet management, and focus on disclosure. Aggressive votes that could knock near-term margins in concentrated sectors are rare. Fee wars reward quiet ownership. Common owners sit atop rival insurers and PBMs. Nobody needs to conspire. Rational pricing becomes the baseline. A microstory tightens the lens. Jordan, a warehouse supervisor, hits the ER for his daughter's breathing scare. In-network hospital, out-of-network physician group. 2 bills. The insurer, also in Alicia's fund, denies the first appeal, then offers a token reprocessing. The integrated company's earnings call later cites commercial pricing tailwinds and disciplined medical cost trend. The stock lifts. Jordan rearranges the car repair budget. Impact lands in wages. Employers push deductibles higher to tame premiums. Raises stall because benefit costs rise. Alicia's plan collects insurer dividends and bond coupons from hospital revenue debt. Her checking account funds the deductible in March and the premium every other Friday. The ledger meets itself. What nobody saw in the waiting room. Private equity-backed physician groups carry debt that needs cash flow. Roll UPS promise scale to negotiate better rates. Better rates are higher allowed amounts. Valuations smooth on quarterly marks inside funds, but the patient experience is lumpy. Surprise bills got curbed by recent laws for many scenarios. Narrow networks and prior authorization delays stepped in where loopholes remain. This was the moment everything changed for Alicia. A $1,940 out-of-network professional charge tied to an in-network visit. She calls the insurer. Courtesy reprocessing trims a little. She calls the hospital. They offer a 12-month payment plan, interest-free if she auto-pays. HR suggests next year's cheaper premium plan with a higher deductible. The choice is which pocket to bruise. Let's put numbers on one page. Her family premium share rises $1,200. The deductible climbs $1,000. Expected out-of-pocket from last year's pattern, $800. Meds after tier changes, another $360. Risk envelope, roughly $3,360. Her portfolio's healthcare sleeve, say $12,000 across insurers, PBMs, hospitals, and suppliers, might throw $300 to $400 in dividends inside the plan. Untouchable without taxes and penalties. The spread hits the grocery line. Human reactions are predictable. Alicia price checks generics, then learns cash prices can be lower than insurance, but don't count toward deductibles. She sets up an HSA, uses the employer seed, then hesitates to spend it, hoping to let it grow. She asks her doctor to code preventive when it's allowed. She shifts routine care to telehealth to dodge facility fees. She spends hours being efficient to a system that engineered efficiency for itself. Meanwhile, consolidation keeps rolling. An insurer buys a primary care group to align incentives. Referrals steer to owned facilities. PBMs tout transparent models for select clients while the core book keeps the spread. Analysts ask about retention and pricing. Executives answer in phrases that Alicia has learned to translate. Value-based care can still mean higher bills. Let's ground the ledger to choices. She compares plans by worst case out-of-pocket, not just premiums. A slightly higher premium that caps catastrophe tighter may smooth her year when a bad Saturday hits. She funds the HSA to the point of expected expense, then spends it, treating it as a deductible wallet, not a trophy. The goal isn't to win the rebate game, it's to miss fewer paychecks. In the aftermath, her plan statement features healthcare innovation. She believes in innovation. She doubts pass-through. Her retirement dollars are long healthcare. Her patience is short. And the system remains very good at charging both. Grocery bill squeeze, from farmland to shelf price. Alicia hoped food would be the easy line. It isn't. Her receipt is a ledger of owners taking a slice from soil to scanner. To see why a jar of sauce now costs what a small treat used to, follow her retirement dollars through the chain they fund: field, inputs, processing, brands, retail, and watch how each step protects margin while her cart absorbs the discipline. Start with the land. Pension-backed farmland funds bid up acreage that families once financed with local banks. Higher purchase prices require lease rates that climb on a schedule. A corn and soy farmer in Iowa signs $305 an acre with a step-up because the neighbor did. Seed and chemical suppliers, consolidated with patents, hold pricing power. Weather stays random. Rent and debt are fixed. The investor gets paid first. Meanwhile, processors defend spread. A grain processor tweaks mix, shifting toward higher-margin products when commodity costs soften. A meat packer with regional leverage slows the line to keep wholesale prices firm. Consumers never see those dials. They see a box that looks the same until it doesn't. Shrinkflation trims ounces, rewraps the claim as right size, and keeps shelf price anchored. Alicia pays more per spoonful without a headline. Now the brands. A handful of conglomerates control the middle of most aisles: cereal, condiments, cleaning, snacks. When portfolios merge, overlapping SKUs get cut and promotions rationalize. Category captains help retailers map the shelf, slotting fees by eye level. Calendars coordinate so discounts don't collide. On earnings calls, the CFO calls it revenue growth management. In the cart, it's the same product for more money or a smaller one for the same. Retailers hold the last key. The largest chains run data science like a hedge fund. They test prices by zip code, promotion cadence by weather, private label by aisle. Private label should restrain brands. Often it captures the spread. When input costs rise, shelf prices move fast. When inputs fall, shelf prices lag. The lag is profit. Everyday low is a strategy. Zone pricing is the fine print. Stakes are weekly and relentless. A 14% jump across Alicia's basket isn't a statistic. It's fewer fresh items, swapping proteins, and telling the kids the snack bin refills every other week now. For retirees on fixed incomes, and for Alicia, who's trying to become one, groceries are the variability that erodes everything else. Action in the aisle. Saturday morning, she reaches for the kids' cereal. 14.7 ounces, where it used to be 16.2. Unit price tag is tiny. The end cap screams family value. She grabs the store brand too, hedging against complaints. At checkout, the receipt includes a loyalty discount she didn't load and a digital coupon she doesn't remember clipping. Total still beats last month. That afternoon, her retirement app features consumer staples, resilient through cycles. Meanwhile, upstream, Farmland funds report inflation-protected income. Input suppliers defend pricing with bundled systems, and processors tout stable gross margins. Brands raise guidance on price realization and productivity. Retailers post strong same-store sales and private label penetration plus 120 BPS. Alicia's Staples sleeve distributes a modest dividend inside the plan. Her pantry costs more. What nobody connects on the portal. When target date funds add real assets for diversification, farmland, midstream logistics, timber, the hedge lives in the account while the toll lives in the kitchen. Common ownership across brands and retailers narrows the contest into stability. Diversification lowers single stock risk. It can also diversify away your price breaks. Let's run Alicia's ledger. If her household spends $9,000 a year on groceries and prices move 14%, that's $1,260 more. Her staples allocation, say 8% of a $90,000 balance, pays a 2.5% dividend, roughly $180 reinvested. She can't or shouldn't touch it. The spread is 9 or 10 grocery trips. It shows up in choices like skipping berries or refilling the bulk rice bin instead. A microstory at the dairy case. Milk wears a big club price tag while the non-club price hides small. She signs up for another program to save 50 cents, trades her data for access, and starts getting offers for categories she never buys. The time tax grows, the cart total holds steady. The retailer's margin expands. The app congratulates her on savings. Impact lands in language. Analysts ask about elasticity. Management says demand, normalized to the new level. Alicia calls it getting used to less. Brands talk value ladders, offering smaller packs at the same price point. Retailers zone price by neighborhood income. Processors normalize fuel surcharges into base rates months after diesel fell. The system calls it discipline. Households call it the squeeze. There's nuance. Some categories are still knife fights. Some retailers wield private label to force brand concessions that do reach the shelf. But the dominant pattern is shelf control by a few, data-enforced stability, and a long pass-through on input declines. When your retirement fund is a common owner up and down that chain, you earn pennies while paying dollars. So Alicia changes tactics. She anchors to unit pricing, batch cooks, moves staples to a monthly warehouse run, and sets a hard no-promo trap rule: no multi-buy unless the unit price wins. She builds a small pantry buffer so she can skip a week when prices spike. She auto-directs taxable dividends to the grocery budget for 3 months, then flips back to reinvest. It isn't optimal on paper. It is optimal for breathing. In the aftermath, investor letters celebrate price realization and mix. The plan's quarterly blurb praises staples as defensive. The defense works inside the account. At home, Alicia tightens the list and keeps chasing unit tags. The market applauds resilience. Her kitchen measures it in ounces. The fee stack, how the house gets paid first. Alicia logs into her portal and sees decimals that look harmless. 0.06% here, 0.12% there. Cheap, right? What she doesn't see in one place is how many meters click before her dollars ever compound. The house gets paid first, quietly in layers. Start with plan administration. Her employer hired a record keeper to handle payroll feeds, statements, websites, and call centers. The cost might be billed as a per-head dollar fee or skimmed as basis points inside fund pricing. Add advice widgets, managed accounts, financial wellness portals, each with menu prices. The more features, the more basis points, and the easier it is to hide the all-in number. Then the target date wrapper. It looks like one fund. Under the hood, it's a fund of funds. The wrapper charges its own expense ratio, then allocates to index and active sleeves that each charge theirs. Disclosures show the wrapper fee. Trading costs inside don't count. Cash held for liquidity doesn't count. Turnover costs during rebalancing don't count. Implementation isn't free, it's just invisible. Now the plumbing that never headlines, securities lending. Index funds lend portfolio holdings to short sellers and earn a spread. Funds say the revenue benefits shareholders. Often it does. But the lending agent, frequently an affiliate, takes a cut off the top. In a low-fee world, that cut matters. Participants rarely see the split. It's a quiet toll on passive. Private markets raise the stakes. If her target date includes a real assets or private credit sleeve, the stated fee might list 1% to 2% management plus performance carry. That's before monitoring fees at portfolio companies, transaction fees, broken deal costs, fund expenses, and valuation services. Marks can smooth volatility. Fees don't smooth. The capital gets called, the tolls get paid, the app shows a steady line, and Alicia never sees the full bill until years later. A micro moment at work. Ben gets an email. Personalized managed account, only 0.35%. He clicks yes. His portfolio becomes the same core index sleeves plus a tactical overlay. He now pays plan admin, fund expenses, and the overlay. No single line feels egregious. Together, they're a siphon. Let's stack Alicia's likely tolls. Record keeping might be 0.08% tucked into revenue sharing. Target date wrapper at 0.12%. Trading drag, spreads, reconstitution, cash, another 0.03% to 0.05%. Securities lending revenue split that favors the agent. Call the participants missed share 0.02% in effect. Advice overlay, if opted in, 0.30% to 0.45%. Add a private sleeve at 1% plus on its portion. A plan that markets low cost can still charge north of 0.4% all-in for a plain path, and over 1% if overlays and illiquids layer in. On $90,000, 0.45% is $405 a year. 1% is $900. Compounded over decades, 1 percentage point is a six-figure haircut. But there's a second leak: revenue sharing and shelf fees. Some funds pay the record keeper for access, sub-TA, or platform fees. Clean share classes strip those out and force the employer to write a visible per-head admin check. Employers often prefer invisible, so participants pay inside the NAV, never seeing a bill. Open architecture sometimes just means more wrappers feeding the same platform. Meanwhile, index isn't frictionless in practice. When new contributions hit on volatile days, orders fill at spreads. When indexes rebalance, fast traders position ahead, creating slippage the fund absorbs. Cash buffers for redemptions create drag. None of this is a scandal. It's plumbing. Plumbing leaks. And complexity pays. Default design, auto-enroll, auto-escalate, target date QDIA, boost savings and asset gathering. Opaque menus keep most participants in the default, which channels flows into the provider's own series. Brokerage windows offer choice with ticket charges and higher expense niche funds. Someone clicks. Distribution revenue shows up. Human stakes land at month end. Alicia trims her contribution by 1% to cover the 12% rent hike. That 1% was the offset to the 1% she's paying in layered fees. Now both move in the wrong direction. Fees don't flex when budgets tighten. They skim the smaller base on schedule. So she builds a fee map. She asks HR for one page. All-in plan admin in dollars per participant. Each fund's expense ratio, any revenue sharing, securities lending splits, estimated trading drag. If the answer is we can't calculate that, that's the first reform target. She requests clean share classes so admin is billed visibly. She compares her target date's wrapper cost to a DIY 3-fund core, total US, total international, total bond, at 0.03% to 0.06% each. If the wrapper plus overlays exceeds that blend by more than a rounding error, she switches. Then she sets a ceiling. Index sleeves under 0.1% all in. No advice overlay unless it beats a written IPS. No private sleeves without a plain English fee waterfall. She opts out of managed accounts. She toggles off any trial services that roll into annual charges. She asks the committee to rebid record keeping and publish apples-to-apples quotes as dollars per head, not basis points buried in NAV. A micro-win. The next quarter, the advisory services line disappears from her statement. Small dollars, big precedent. Opt-in only labeled in cash. She's not chasing purity, she's cutting permanent tolls. Here's the quiet point. Markets can give back a bad year. Fees don't. Every basis point is a guaranteed negative return that compounds forever. Alicia can't control index concentration or rent algorithms today. She can control how many hands touch each dollar before it starts working for her. The house will always get paid. Her job is to make it earn it, and to see the bill. Index power, when passive voting isn't passive. Alicia's portal shows tidy tickers and tiny fees, but the real leverage hides in share counts and ballots. Her target date fund feeds giant index sleeves. Those sleeves, pooled with millions of savers, make a few firms the largest owners of airlines and hospitals, grocers and drug makers, landlords and utilities. Passive describes the trading. The votes aren't passive at all. Start with concentration. The biggest index sponsors sit top 3 across thousands of companies. They own rival landlords on the same street, rival insurers in the same market, and rival brands across the same aisle. Nobody needs a call to soften a price war. When owners are common, rational pricing becomes the baseline. Alicia's household would benefit from a promotion war. Her portfolio prefers a truce. Action moves behind closed doors each proxy season. Stewardship teams, small relative to the trillions they oversee, process thousands of ballots on tight timelines. They meet with boards, push disclosure, and publish principles. What they rarely do is back proposals that could dent near-term margins in concentrated industries, like requiring pass-through speed when input costs fall, or reporting renewal spread policies in housing, or expanding price transparency in pharmacy channels. Rocking the boat risks access, invites political fire, and in a fee war can push clients to a cheaper rival. So engagement stays procedural. Continuity wins. Meanwhile, marketing adds misdirection. Sustainable, thematic, and ESG wrappers proliferate with slightly higher expense ratios. Many hold the same giants the core index does. The ownership map doesn't change, the label does. Alicia's money gets greener. Her rent letter doesn't. A micro-moment puts it on the aisle. A national grocer faces a shareholder proposal asking the board to assess price pass-through timing when commodity costs decline. Management recommends against it. Operational burden, competitive sensitivity. Index sponsors cite improved disclosure in other areas and vote with management. Directors clear 94% approval. Next quarter, the CFO praises price realization and mix. Alicia pays for the new family size that's smaller than the old one. Impact lands quietly. When the same stewards vote across competitors, they can clean up governance while preserving industry stability. Stability props up margins. Margins support dividends and index returns. The household needs certain kinds of instability. The kind that looks like aggressive promotions, a landlord courting renewals with lower increases, an insurer cutting facility fee abuses. Her index fund diversifies her away from those fights. Her life still pays the bill. But here's the twist: scale is power. Index managers can't threaten to sell the index, but they can escalate on votes. Silence is a stance. So is a private nudge without consequences. Boards listen when a universal owner signals displeasure. They relax when it signals acceptance. Fee competition makes loud fights risky. Quiet continuity is safer. Now remember the incentive stack. Asset managers get paid on assets gathered. Redemptions are bad. Industry price wars can compress profits and wobble stocks across an entire sector they must own. Voting to preserve stability aligns with their business model. It doesn't align with Alicia's receipt. There's also a dual loyalty problem nobody reconciles. As a beneficiary, Alicia wants higher returns. As a consumer, she needs lower prices. The stewards hold her proxy for one identity and ignore the other. They'll argue that long-term value includes reputation risk and regulatory risk. They're right, but consumer welfare in concentrated markets often needs explicit pressure, not just letters about disclosure. A microstory at the lease office shows the gap. A proposal asks a large landlord to disclose renewal spread medians by metro and fee policy changes. Management resists. The big indexes vote with management. The platform's year-end deck touts resident satisfaction and pricing discipline. Alicia's renewal lands at plus 9% plus a tech fee. The boardroom never hears from her plan that affordability is a material risk. It hears that engagement went well. So what can move? Plans can adopt sector-specific proxy guidelines that weigh consumer impact where participants spend: housing, healthcare, staples, utilities. They can ask managers to publish rationales when voting against price transparency or renewal spread disclosures. They can split mandates, use a second index provider for those sectors. So no single steward sets every boundary. None of this sparks a price war overnight. It changes the waterline. Alicia can push her committee to request a simple map: top holdings against her household's top costs. Then ask managers one question: how did you vote on proposals that would have clarified pricing, pass-through, facility fees, or renewal practices? If the answer is with management, ask why. If the why is process, ask for policy. Stealth power requires stealth pressure. The votes already shape her bills. The least she can demand is that they admit it. Risk transfer: you hold the bag, they keep the upside. Alicia's HR meeting looks harmless. New benefits portal, same match, a slide about participant empowerment. Years ago, the company froze its pension and shifted to a 401k. Controls sounded modern. What changed, quietly, was who carries market shocks. The volatility that used to live on a company balance sheet now rides home in Alicia's hatchback. Defined benefit plans promised a paycheck for life. Sponsors worried about funding gaps, interest rates, and people living longer. Consultants pitched defined contribution as a fix: predictable employer costs, fewer headlines. The match stayed, the risk moved. The upside still belongs to markets. The downside, bad timing, ugly sequences, withdrawals during dips, belongs to Alicia. Sequence risk is the hazard nobody feels until the wrong birthday. Markets don't deliver returns in order. If a deep drawdown hits right before or after retirement, withdrawals lock in losses a 30-year-old can shrug off and a 64-year-old can't. Glide paths promise safety by shifting into bonds. But safety in quotes isn't protection when inflation runs hot and long-duration bonds fall with stocks. On a chart, the glide path looks calm. In a grocery aisle, it doesn't. Meanwhile, the hunt for yield smuggles risk under friendly labels. Income funds advertise 6% to 8% payouts. Underneath, leverage and covenant-light loans wobble when credit tightens. Structured notes offer buffers with complex triggers. Closed-end funds promise distribution stability, then cut when markets force it. The brochures smile. The fee meter never blinks. Private markets step in with smoother lines. Target date funds add real assets or private credit sleeves that mark quarterly to models. The app shows steadier net asset values. Reality shows liquidity that vanishes when you need it. If a downturn hits and the plan rebalances, liquid equities take the hit because the illiquid sleeves can't sell. Alicia still has rent due. Her diversifier can't move. A micro-story at the worst moment. Marcus, 2 years from retiring, opens his statement after a year when both stocks and long bonds fell. His managed account had shifted him to 45% bonds. He didn't panic sell. He had to take a distribution to cover a medical bill. The withdrawal locked losses. Fees continued, unbothered. He received an email. Stay the course. He did. The dollars he took out weren't there to rebound. Impact sits in incentives. Providers earn basis points through rallies and through dips. Assets down, basis points steady. Record keepers collect admin, consultants collect retainers. Asset managers clip their fees whether Alicia pauses contributions or not. The product set looks like a pension without guarantees. The guarantees cost money. The risk transfer is complete. But there's a second trap. Household fixed costs raise the chance Alicia becomes a forced seller. A 12% rent hike, a higher premium, and a grocery squeeze leave less slack. When a shock lands, people pause contributions or take loans. The system calls that leakage. In kitchens, it's survival. Leakage compounds the transfer. Fewer shares bought during drawdowns, fewer shares to rebound later, a tighter retirement budget. Now remember, not every annuity pitch is predatory. Some secure income options are fair, transparent fees, simple mechanics. Others build in spreads that move more upside to insurers than participants realize. Guarantees cost what they cost. If Alicia buys one, she's paying an insurer to hold the risk her employer used to hold. That can be smart. It should be deliberate. Design can blunt transfer pain. Alicia builds a sequence shield. 6 to 12 months of core expenses in cash, and a soon sleeve of short treasuries and tips covering 2 to 5 years of planned withdrawals. She writes a rule: don't sell equities for spending for at least 2 years. Buckets by time. Time turns volatility into noise. Plan design can help or hurt. A default stable value sleeve near. Retirement is useful if it's clean and liquid. A long-duration bond tilt can be a problem when rates reset from zero. Alicia shortens duration in the soon bucket and uses tips for part of it to add inflation linkage. She caps illiquids so rebalancing stays possible. She treats appraisal marks as soft, not spendable. A micro rule to stop forced selling. Alicia automates a small cash buffer build and sets a panic protocol. No allocation changes within 72 hours of scary headlines. Any change must be written, sleep on it, then reread. She shares it with a friend who agrees to sanity check. In the next wobble, she draws from cash, not stocks. Her statement still shows red. Her checking account doesn't. Social Security timing is sequence leverage most people ignore. Delaying to 70 raises the inflation-adjusted base materially. For average health, it's the cheapest annuity she'll ever buy. The bridge is the challenge. Buckets fund the bridge. If Alicia can cover 62 to 70 with part-time work and savings, she reduces lifetime risk more than any clever product. Debt is sequence risk with interest. Variable rate cards or personal loans turn downturns into compounding against you. Alicia kills double-digit balances first. Fixed housing costs become leverage in disguise. She avoids stretching for a mortgage that would squeeze contributions during a slump. The quiet truth: markets recover, withdrawals don't. Providers keep basis points, participants carry variance. Alicia can't move the risk back to her employer. She can move it into a cage: time buckets, low duration soon money, a cash buffer, delayed Social Security, fewer illiquids, and fixed costs that bend. That's how you hold the upside without holding the bag. Case study: a real estate platform and the rent hike loop. 3 summers ago, a real estate platform rolled out a plan it called Stitch the Sunbelt. The strategy was simple and scalable. Buy mid-market apartment communities across Phoenix, Tampa, Charlotte, and Dallas. Centralize leasing and maintenance. Plug in revenue management software. Renovate select units, and standardize fees. The investor deck promised scale-driven NOI growth. Alicia's retirement dollars own the platform's public cousin through index sleeves, and her target date funds private allocation co-invested in off-exchange portfolios. The ownership looked diversified. The playbook was one page. Stakes first. This isn't abstract yield. It's where people sleep. In Phoenix, a 220-unit garden complex called Desert Willow changed hands. Residents got a cheerful welcome packet, a new portal login, and a promise of upgrades. 90 days later, they got renewal terms keyed to software. For single parents, retirees, and nurses on shifts, the number on that letter decided whether kids stayed in their school or boxes got packed over a weekend. Action. The acquisition closed at a cap rate that only penciled if rents climbed. Renovation teams prioritized units with leases expiring soon. Stainless, vinyl plank, two-tone paint, value add that photo tested well. The software scraped comps nightly and spat out renewal spreads by unit type. Local staff could ask for exceptions. Corporate could override with a click. Add in a menu of ancillary revenue. $35 valet trash, community tech fees, reserved parking, and the spreadsheet started breathing. Unknown to residents, across town, sister assets were running the same cadence. A 300-unit property nudged base rents 9% after adding package lockers and a dog run. A smaller complex layered a Wi-Fi bundle, shifting a cost onto a line item. Maintenance staffing got optimized, replaced by regional floaters dispatched via app. Turn times improved a bit, response times stretched. Occupancy dipped a hair, margins expanded. The supplement to investors showed same-store revenue plus 8%, turnover down, and pricing discipline. This was the moment everything changed for Maya, a teacher at Desert Willow. Her renewal arrived. $1,635 to $1,825, plus $35 valet trash, and a new $50 reserved space she hadn't asked for. She brought 12 months of on-time payments and pay stubs to the office. The site manager typed, then said, "We price with market data. Can I talk to someone? We'll ask corporate." The answer came back fast. A one-time $200 loyalty credit if she signed within 48 hours. The rate held. Meanwhile, the earnings call. The platform's CEO told analysts renewal spreads remain robust, operating efficiencies ramping, and renovations driving double-digit uplift. Slides spotlighted Phoenix, Tampa, Charlotte. Another slide noted rising interest expense. Floating rate exposure made rent discipline important. On Alicia's portal, the real estate sleeve showed stable income. In Maya's budget, the spread ate the money she'd set aside for a break job. Impact radiated through the metro. Independent owners sold into the roll-up. With fewer small landlords offering below-market renewals, the negotiation. Anchor moved. Data-driven pricing isn't illegal, it's efficient. But common ownership across listed landlords. Index sponsors holding top 3 stakes in everyone blunted the appetite to undercut. Nobody needed a call. The equilibrium drifted toward rational. The resident paid the rational. Let's run the ledger. A 10% bump on $1,600 is $160 a month, $1,920 a year, plus $35 in new fees. Call it $2,340 after tax. Pre-tax wages needed to cover it, roughly $3,200. If Alicia's plan had $40,000 in a real estate sleeve at a 4% yield, that's $1,600 inside a tax-advantaged account she can't tap without penalty. The defensive return posted in a place she couldn't spend. The cash left her checking now. A microstory from Tampa. Devin, a nurse, called to negotiate a 12% bump. She pointed to perfect payment history. The agent offered a $150 loyalty credit if she signed by Friday. She toured a cheaper complex 15 miles away. Deposits, parking, and tech narrowed the gap. Her current place matched half the difference. She stayed and picked up a weekend shift. The platform logged retention. The quarter logged churn reduction. Meanwhile, property taxes climbed post-sale. Those passed through. Insurance premiums rose. Those too. Underwriting still worked because the pro forma assumed steady rent growth and modest capex. The securitization market bought the loans. Alicia's bond sleeve clipped coupons from the structures built on top of residents' checks. What about supply? New units help, after years. Zoning, rates, labor, and materials slow delivery. When supply lags, software wins. Caps and rent stabilization shape behavior at the edges. Fees and amenity upgrades work around them. If caps sunset, deferred hikes land fast. The platform's line stays smooth. The residence doesn't. A contested narrative belongs here. Tenant and labor reports in San Diego flagged aggressive increases at institutional portfolios, while large owners highlighted capital improvements, service upgrades, higher satisfaction, and compliance with state caps. Both frames can be true at once. Amenities can improve while renewal spreads run hot. Your 401k sits on the cap table either way. Human reactions adapt. Residents trade scripts in group chats. Ask for a 2-year with a smaller first-year bump. Escalate to regional. Request fee waivers. Cite school year timing. Some wins stick. Most don't. The model counts on friction, moving costs, time, uncertainty, to keep renewals rational. In the aftermath, analysts asked whether the spread was sustainable. Management cited constrained supply and household formation. Index funds accumulated more shares by mandate. Alicia kept contributing. Maya signed, then skipped a trip to the dentist. The dividend reinvested itself. The rent cleared. The loop closed. Case Study B: Insurer/PBM integration and the premium spiral. The premium hike didn't appear out of nowhere. It was engineered upstream. To watch the gears turn, follow one company with 3 faces: insurer, PBM, and specialty pharmacy under the same roof. Integration promised efficiency. What Alicia didn't see in HR slides was how the spread moved from her paycheck into a line item her retirement fund quietly owned. Stakes first. Premiums come out before groceries. Deductibles don't negotiate. A kid's inhaler can't wait for budget day. A $2,000 deductible plus a higher copay means postponing braces, rationing PT, and paying cash for a generic because the insurance price is worse. Every dollar to healthcare is a dollar not compounding. Action begins at the pharmacy counter. The PBM designs a formulary: Tier 1 generics, Tier 2 preferred brands, Tier 3 non-preferred, specialty off to its own category. Manufacturers pay rebates to stay preferred. Rebates are calculated off the list price. Therefore, higher list prices create bigger rebates. The insurer, sharing a parent with the PBM, can apply rebates to lower employer quotes while shifting members to co-insurance and higher deductibles. Employers see savings. Alicia pays a percentage of an inflated anchor. When a drug moves tiers mid-year under formulary optimization, her copay triples. The manufacturer's coupon doesn't count toward the deductible. The PBM's group purchasing arm clips an administration fee. The specialty pharmacy, also under the same parent, captures margin when complex meds are forced in-house. Meanwhile, hospital consolidation reflags clinics as outpatient departments. Identical procedures pick up facility fees. An ankle x-ray becomes 2 bills, technical and professional, separate networks, separate appeals. Integration on the insurer side expands into clinics and primary care. Aligned incentives becomes captive referral patterns. Medical loss ratio targets get met while the spread migrates into non-MLR categories like pharmacy benefit services and admin fees. A microstory ties it to Alicia Street. Luis, a diabetic forklift operator, picks up insulin. Last year, $35. This year, $85 because the plan moved to coinsurance and nudged the preferred brand. The pharmacist offers a manufacturer card, drops out of pocket to $25, but it doesn't count toward the deductible. A month later, a lab bill hits. He's still far from the threshold. On earnings day, the integrated company cites pharmacy services growth and disciplined medical cost trend. The stock ticks up. Luis cancels a Saturday outing. Impact ricochets into wages. Employers push higher deductibles and narrower networks to tame premiums. Raises lag because benefit costs rise. The insurer's stock in Alicia's portfolio pays a dividend. Her bond sleeve holds the insurer's debt that financed buybacks. Her checking account funds the gap between trend management and Tuesday night. What nobody sees in the plan brochure. The PBM's rebate structure makes the biggest discounts on the drugs with the highest list prices. The rebate checks often don't reach Alicia directly. They show up as a lower gross premium than it would have been, paired with higher cost sharing that erodes her month to month. Spread lives between negotiated net and what she pays at the counter. The same spread funds the services revenue line. Another microstory. Ben's employer is self-funded. The insurer just administers claims. The broker pitches a 3-year rate cap if they accept a tighter formulary and a narrower network. The spreadsheet sings, lower projected costs. Nobody at the table has a kid whose allergist is now out of network. The plan signs. Ben learns the new clinic has a 6-week wait. Price transparency laws improved surprise billing for many ER scenarios, but complexity moved. Prior authorization delays increase, particularly for specialty meds routed through the in-house pharmacy. Integration tightens the loop. The PBM decides access, the pharmacy fulfills, the insurer adjudicates. Appeals feel circular because they are. Let's run Alicia's ledger in one frame. Family premium share up $1,200. Deductible up $1,000. Expected out-of-pocket based on last year's visits, $800. Tier changes on 2 meds add roughly $360 net. Risk envelope, around $3,360. For portfolio's healthcare sleeve, say $12,000 across insurer/PBM heavy indexes and hospital/medtech names. Might throw $300 to $400 in dividends inside the plan, untouchable without penalty. The spread lands in her grocery line. Meanwhile, stewards vote the proxies. A shareholder proposal asks an integrated insurer/PBM to report rebate pass-through metrics and member out-of-pocket impacts. Management calls it operationally burdensome. The big index sponsors vote with management, citing ongoing engagement. Continuity wins, clarity loses. Alicia's plan remains long the spread and silent about its household cost. Human reactions follow the script. Alicia shops cash. Prices for generics, learns GoodRx beats her copay, but doesn't count toward the deductible, and chooses cash anyway. She switches routine visits to telehealth to dodge facility fees. She funds the HSA to the point of expected spend, then actually spends it, treating it as a deductible wallet, not a trophy. She checks if her plan's transparent pharmacy model exists. If not, she asks HR why not. She writes 2 lines for open enrollment. Pick the plan with the lowest worst-case out-of-pocket she can actually cash flow, and avoid tier structures that force coinsurance on everyday meds. In the aftermath, the integrated company launches a lowering costs campaign for select clients. The core book keeps the old spread. Analysts ask about retention and pricing. Executives answer with commercial tailwinds. Alicia sets a reminder to request her plan's PBM contract disclosure next quarter, then makes dinner with the cheaper brand of pasta sauce. The premium autodraft hits tomorrow at 6 a.m. Case Study C. Consumer staples consolidation and shelf control. Walk the aisle with Alicia, and you can read the playbook without opening an investor deck. The top shelf is a legacy brand, the middle shouts family size. The bottom is a private label that looks like the brand. 3 companies control almost everything in that lane. Her retirement dollars own all 3 through broad index sleeves. Stakes first. This is breakfast, lunches, laundry, toothpaste, rituals that quietly turn into line items. When ounces slip and prices hold, Alicia isn't modeling elasticities. She's negotiating with a barcode after work. Every extra dollar to Staples is a dollar not saved. Every value pack that isn't squeezes her time and her cash the same week her rent renews. Action starts long before her cart. 2 consumer giants merge portfolios and rationalize SKUs. Category captains advise the retailer on planograms. Eye level for anchors, end caps for new, bottom shelf for the imitation. Slotting fees by placement. Promotion calendars synchronize across brands to avoid head-to-head discounting. The CFO calls it disciplined revenue growth management. The shelf calls it stability. Inside factories, input swings become profit architecture. When commodities spike, brands move fast. List price increases next quarter. Pack architecture adjustments to preserve accessibility. When commodities fall, reinvestment in brand and pricing architecture optimization. Take the mic shelf prices lag declines. Margin recapture fills the gap. Your Staples ETF applauds sturdiness. Alicia pays at the scanner. Unknown to shoppers, the retailer runs its own math. Private label has leveled up, same co-packers, cleaner labels, better packaging. The spread against brands narrows just enough to encourage trial without igniting a price war. Data teams test prices by zip code, weather, and loyalty clip rates. Zone pricing lives in tiny tags. The aisle becomes a lab. Alicia's portfolio owns the retailer too. A micro moment lands in cereal. The kid's favorite box used to be 16.2 ounces. It's 14.7 now. Same shelf price, new family size ribbon. Unit price tag is small, the end cap screams value. She grabs the store brand as a hedge. At checkout, The receipt shows a loyalty discount she didn't load and a digital coupon she doesn't remember. Total still tops last month. Her plan app later features consumer staples, resilient through cycles. Impact shows up on calls. The brand conglomerate reports, net price plus 9%, volume minus 3%, mix positive. Translation: raised prices, people bought a bit less, but more profitable items. The retailer reports private label penetration plus 120 BPS, gross margin expansion. Analysts ask if elasticity bit harder. Management says consumers normalized to the new level. Alicia calls it getting used to less. Meanwhile, processors defend spread in the shadows. A bread producer trims loaf length 2 slices and calls it consistent bake. A condiment maker swaps glass for plastic, markets sustainability, and lifts price quietly. Distributors tack on fuel surcharges. Months later, the surcharge becomes the base. Each tweak is small, the roll-up is real. What nobody connects from the portal: diversified ownership narrows the contest. The same index sleeves hold brand A, brand B, and retailer R. Nobody needs a smoky room. Everyone knows the boundaries, respect promotion windows, pass input spikes quickly, let declines lag, protect shelf space, target mix over volume. The competitive set converges on stability. Stability supports dividends and index performance. It's expensive for dinner. Let's run Alicia's ledger. Detergent shrinks from 100 loads to 92 with concentrated formula. Per load cost rises 7%. Snack multipacks drop 2 bags, wrapper font grows. Beverages require buy 3 to get yesterday's unit price for 1. Across the basket, Alicia's $9,000 annual grocery spend faces a 14% rise. $1, $260 more. Her staples sleeve, say 8% of A. $90,000 balance, throws a 2.5% yield, around $180, reinvested inside the plan. She can't use it. The spread is 9 or 10 grocery runs. A second microstory at dairy. Milk flashes a bold club price. The non-club price hides small. She signs up for another program to save 50 cents, trades her data for access, and gets weekly emails for categories she never buys. The time tax grows, the cart total holds. The retailer's same-store sales improve. There's nuance. Some lanes still fight. Warehouse clubs cannibalize grocer margin for basket loyalty. Discounters undercut in targeted zip codes. But the dominant pattern is shelf control by a few, data-enforced discipline, and long pass-through when inputs fall. Common ownership threads through it. Meanwhile, stewardship stays polite. A shareholder proposal asks a grocer to disclose pass-through timing when commodity costs decline. Management calls it operationally burdensome. The big index stewards vote with management, citing engagement progress. Directors clear easily. Next quarter, price realization takes a bow again. Human reactions adapt. Alicia shifts to unit pricing, batch cooks, does one warehouse run a month, and makes a no promo trap rule, no multi-buy unless the unit math wins. She directs taxable dividends to the grocery budget for a quarter, then flips back to reinvest. It's not optimal on paper, it is optimal for breathing. In the aftermath, brand CEOs talk consumer trust, launch downsized trial packs, and promise value ladders. Retailers tout everyday low prices, then slide zone pricing by neighborhood income. Analyst decks glow. Alicia unloads the same bag and finds less. Her retirement dollars clap for resilience. Her kitchen measures it in ounces. The structural trap, why this keeps happening. Alicia keeps asking the same question. If everyone says they're helping savers, why does her life feel tighter every year? The answer isn't a villain. It's a machine built from incentives that rhyme across finance, benefits, and boardrooms, and it runs until someone rewrites the rules. Start with asset gathering. Expense ratios fell, but business models still pay on assets. Therefore, providers hardwire stickiness, auto-enroll, auto-escalate, target date as default. Money flows predictably into a few complexes. Those complexes become universal owners across industries. Universal owners value stability because volatility risks redemptions. Stability favors rational pricing. Alicia funds the rational every paycheck and meets it at the register. Record-keeping plays the same tune. Plans are won in RFPs with bundled features that look free but bill in basis points. Advice overlays, wellness portals, managed accounts. Each adds a quiet toll that scales with balances. CleanShare classes would strip out kickbacks and force visible, per head admin checks. Visible checks get negotiated. Invisible basis points persist. Committees prefer optics. Participants pay inside the NAV. Consultants benchmark performance on 3- and 5-year ranks. Fall behind and clients threaten to move. Rock pricing power in concentrated sectors, and you risk near-term underperformance. The safest career move is to hug the index, publish stewardship letters, and avoid votes that dent margins. Fee wars reward scale and predictability, not confrontation. Polite engagement becomes policy. Continuity wins. Regulation tried to cure opacity with disclosure. PDFs got thicker. Participants got more pages, not one number that says, here's the all-in cost this year. Revenue sharing shifts dollars behind the scenes. Securities lending splits hide in footnotes. Trading drag never appears. Compliance boxes get checked. Alicia's ledger doesn't. Private markets found a side door. Diversification justified higher fees and appraisal marks that look smooth. CIOs and committees like smoother lines, fewer meetings, fewer headlines. The full fee waterfall, management, carry, transaction, monitoring, broken deals, rarely lands on one page for participants. The machine collects at every step. The app shows stability. Liquidity is someone else's problem until it isn't. Stewardship carries a built-in conflict. As an investor, Alicia wants higher returns. As a consumer, she needs lower prices. The stewards hold her proxies for the first identity and ignore the second. They'll say long-term value includes reputation and regulatory risk. True, but in concentrated markets, price discipline survives polite letters. It bends when votes escalate and policies change. Escalation is rare because fee competition punishes noise. Short-term scoreboards entrench it. Quarterly flows judge managers. Committee tenures are short. Wins need to fit a fiscal year. A proxy fight that pressures a grocer to pass input declines faster might shave a sector's margins now while helping households. Few careers get built on that trade. The index must own everyone. The steward chooses continuity. Political economy cements the rails. Providers fund trade groups that narrow fiduciary standards. Portfolio companies lobby on consolidation rules, facility fees, and pharmacy opacity. Plans are run by committees with day jobs, limited time, and relationships with vendors who've always been good partners. A move to CleanShares drags finance into writing a visible check. Finance box. The invisible tax continues. Open architecture often isn't. Shelf space goes to funds that pay platform fees. Brokerage windows satisfy power users while nudging a minority into higher-cost corners. Managed accounts earn overlays for rearranging the same index sleeves. Each add-on shaves compounding. Each shave is forever. Common ownership finishes the loop. When the same stewards sit atop rival landlords, rival insurers, rival brands, price wars become less attractive than rationality. Nobody needs a call. Everyone knows the boundary lines. Don't undercut enough to spook the sector. Dividends and buybacks look steady. Alicia's receipts do too, just higher. Micro-story from a committee room. HR proposes moving to CleanShares and paying admin per head so participants see true costs. Finance says it hurts the budget. The consultant offers fee levelization. Keep revenue sharing, smooth differences. It sounds fair. It preserves opacity. The vote passes. The all-in number stays buried. Alicia never sees a bill. She pays it anyway. There's nuance worth holding. Index funds democratized investing. Auto-enroll boosted participation. Private capital can fund real projects. None of that excuses a machine that taxes households through pricing power while skimming basis points from the savings meant to fight that power. The trap is structural. Scale paid on assets gathered. Menus designed for stickiness. Stewardship optimized for stability. Disclosure that hides the bill. Politics that prefer invisible costs. Why it keeps happening is why it can change. Incentives are design problems. If admin gets billed in dollars, sponsors negotiate harder. If QDIAs carry fee caps in policy, providers compete on cost. If proxy guidelines weigh consumer impact in sectors that set participant bills, stewards feel pressure to vote for clarity, not just letters. If plans publish one all-in number quarterly, participants build coalitions. Squeaks become hinges. Alicia can't flip the machine. She can force it to show the meter, refuse optional tolls, and back policies that move quiet costs into daylight. The system's default is smooth lines for capital and rough edges for households. The fix starts where the paycheck meets the plan, and spreads when 10 people ask the same hard question in writing. Guardrails you control, reduce friction, increase clarity. Alicia can't unwind index concentration tonight, but she can stop paying tolls she doesn't need and force the ones she can't avoid into daylight. Guardrails don't solve the paradox, they shrink the spread. Start with one rule. Every dollar should either buy you time or earn you money. If it does neither, it's a toll. First, fee triage. Ask HR for one page that shows the plan's all in, per participant admin in dollars, each fund's expense ratio, any revenue sharing, the securities lending split, and an estimate of trading drag. If they can't produce it, that's your first campaign. Meanwhile, cut your own friction. Compare your target date wrapper's cost to a 3-fund core, total US, total international, total bond, at true rock bottom expense ratios. If the wrapper plus overlays beats that core by more than a rounding error, switch. Second, kill optional overlays. Managed accounts that rearrange the same index sleeves for 0.30% to 0.45%. Opt out unless they do something you can write in one sentence that you can't automate yourself. Turn off trial tools that roll into annual charges. If advice matters, pay a flat fee once to build a written plan. Cheaper than a lifetime skim. Third, menu hygiene. If your default includes private credit, real assets, or anything with 2 layers of fees you can't map on one page, opt into the plain index core. Illiquids belong in big institutional pools with long horizons and true governance, not in defaults for workers with rent due. If your plan insists on alternatives, ask for a plain English fee waterfall, appraisal policy, and cash flow profile. If they can't explain it to a room of employees in under 10 minutes, it doesn't belong in the QDIA. Fourth, administrative visibility. Push your committee to adopt clean share classes across the menu and bill record keeping as a dollar amount per head. Dollars get negotiated, basis points hide. Ask for a documented QDIA fee cap, write the number down. If the current provider can't meet it, rebid. Require apples-to-apples vendor quotes. Same headcount, same payroll complexity, same service levels, shown in dollars and basis points. Fifth, proxy guardrails. You won't fix common ownership alone, but you can ask for a sector-specific voting policy where participants spend the most: housing, healthcare, staples, utilities. That policy should weigh consumer impact when considering proposals on renewal spread disclosure, facility fees, price pass-through timing, and shrinkflation reporting. Demand published vote rationales. If managers vote with management every time while claiming engagement, ask for a second index provider in those sectors and split flows. Sixth, asset location and simplicity. Inside tax-advantaged accounts, hold tax-inefficient income, bonds, REITs. Keep broad equity indexes in taxable to harvest losses and manage gains. Automate rebalancing with bands, say 5% drift, using contributions first so you're not churning. Fewer funds, fewer errors, lower costs. Seventh, cash that buys time. Build a sequence shield. 3 to 6 months of core expenses and high-yield savings, plus a soon sleeve, short treasuries and tips, for 1 to 3 years of known near-term needs. That buffer lets you keep contributing through downturns and skip panic sales. Treat your HSA like a deductible wallet first. Fund it, then spend it on actual care, before turning it into a long-term investment. Eighth, fixed cost surgery. Fixed bills are leverage against you. Negotiate a longer lease for a smaller first-year bump. Ask for fee waivers. Escalate to regional managers. Requote insurance. Switch mobile plans. Cut subscriptions that drifted back on. The dollars you free become automatic transfers. Half to the now bucket, half to raise your contribution rate by 1%. Lock the change the day you win it. Ninth, an IPS for real life. One page written, target savings rate, target allocation, rebalancing bands, fund tickers, fee ceiling, when you'll break the rules. Tape it inside a cabinet. When markets wobble or a glossy product lands in your inbox, read the page aloud. If the pitch doesn't beat your IPS on cost, clarity, and control, it's a no. 10th, coalition building. One email becomes 10. Circulate a 2-paragraph ask to coworkers. Publish the all-in number. Move to clean shares. Cap the QDIA fee. Rebid on a schedule. Adopt a consumer impact proxy guideline with public vote rationales. Put a date on each. Ask for minutes. If you're in a public plan, request an annual household cost map that ties top holdings to rent, premiums, groceries, and utilities by region. Sunlight changes bids and behavior. Micro wins matter. Alicia toggles off a managed account, saves 0.35%. She swaps to the core 3 funds, saves 0.2%. HR publishes the all-in. The committee moves to clean shares. Admin becomes a flat $48 per head and gets negotiated down next year. At home, she trims $118 a month from insurance and phone, locks a 2-year lease with a smaller first-year bump, and sets a $100 auto transfer to refill her now bucket. She raises her contribution 1%. Guardrails aren't grand gestures. They're small rules that lower fixed costs, expose hidden tolls, and put cash where volatility can't reach. Alicia can't control boardrooms. She can control basis points, buckets, and her plan's policy page. That's how you keep more of what you earn while you wait for the system to catch up. Collective pressure, plan-level reforms that move needles. Alicia can pare her own tolls, but the bigger lever sits where payroll meets policy. One person asking questions is a squeak. 10 people with a list become a hinge. Start with sunlight. Ask the committee for a 1-page, plain English fee sheet posted where people actually click. Not a prospectus, not a legal appendix. 1 page per option. Expense ratio, any revenue sharing, sub-transfer agency fees, securities lending split, and an estimate of trading drag. Add a line for the plan's per participant admin fee in dollars. Total it into an all-in for each fund and an all-in for the plan. If the answer is it's complicated, that's the point. Complexity hides tolls. Sunlight changes bids. Force apples to apples when vendors line up. Same participant count, payroll frequency, service levels, cybersecurity, call center metrics. Then show cost both as basis points and as dollars per head. Require disclosure of any payments from funds to the record keeper. Publish the shortlist to employees. When providers know thousands of eyes will see the sheet, pricing moves. Redesign defaults like you mean it. Set the QDIA to the cheapest broadly diversified option you can buy. Whether that's a vanilla target date series with a strict fee cap or a 3-fund blend implemented by the record keeper. Put the cap in policy in writing. Strip managed account overlays from defaults. Offer them only as explicit opt-ins, labeled in dollars per year at today's balance. Auto-rebalance, auto-escalate, and auto-opt-out overlays, not in. Kill kickbacks. Move menu slots to clean share classes that don't pay the record keeper. Write a visible admin check per participant. Dollars get negotiated, basis points persist. If finance balks, show them how visibility lowers cost over time. Publish the admin fee. Schedule a rebid cadence. Every 3 to 5 years, no matter how cozy the relationship feels. Vendors behave differently when a calendar forces them back to market. Guardrails for outs. If anyone proposes private credit, real assets, or private equity in a DC plan, require a participant-facing summary. Full fee waterfall, including management, carry, transaction, monitoring, and broken deal costs. Appraisal policy and valuation lag. Redemption terms and gates. Cash flow profile across vintages, and who gets paid when. Never default into illiquids. Cap exposure. If a manager won't lay out the waterfall in plain English, the answer is no. Make stewardship tangible. Adopt sector-specific proxy guidelines where participants spend. Housing, healthcare, staples, utilities. Direct your managers to weigh consumer impact when voting on proposals about renewal spreads and fees, facility fee transparency, rebate pass-through, shrinkflation reporting, and pass-through timing when input costs fall. Demand published vote rationales per proposal in those sectors. If a manager votes with management every time, require an explanation. If explanations become boilerplate, split mandates. Add a second index provider for those sectors and divide flows. Choice is pressure. Map exposure to life. Publish an annual household cost map that ties the plan's top holdings to the top spend categories by region. Landlords by metro, hospital systems by service area, staples by category, utilities by service territory. This isn't a blacklist, it's a mirror. Pair it with a stewardship appendix that shows how votes addressed those exposures. If votes didn't say so, the gap itself becomes an agenda. Audit add-ons. Inventory every benefit the record keeper sells. Advice widgets, budgeting portals, webinars, calculators. Measure usage. If engagement is weak, cut the tool or convert basis point pricing to a flat, opt-in dollar fee. Basis points on large balances act like a quiet tax on older workers to subsidize everyone else. Make subsidies explicit or stop them. Create a participant council. Hourly, salaried, near retirees, early career. Meet quarterly with the fiduciary committee. Review the fee sheet, service issues, and menu changes before they lock. Publish minutes. If you're a public plan, invite unions and retirees. Outside eyes break habit loops. Bake timing into governance. Put the rebid date on the website. Put the QDIA fee cap in the investment policy statement. Put the clean share requirement in the record-keeping contract. Add a clause that triggers penalty-free termination if revenue sharing creeps back in. Add a clause that requires managers to report securities lending splits in dollars to participants annually. Hard edges beat hopes. Coordinate across employers. Share templates, the one-page fee sheet, the vendor RFP grid, the stewardship guideline addendum, the household cost map. If 10 mid-size plans use the same template, providers conform. If a consultant blocks it, ask for the template in writing. If they won't provide it, consider replacing them. Consultants answer to committees that act together. A. Microscene shows the hinge move. Alicia and 6 co-workers meet HR, finance, and the consultant at lunch. They slide one page, publish the all-in fee by quarter's end, convert to clean shares with a per-head admin by year-end, cap the QDIA at a named basis point number, rebid record-keeping next spring, adopt a proxy guideline for housing, healthcare, staples, and utilities with public vote rationales. Finance objects to writing a check. The consultant suggests levelization. Alicia asks, "Can we at least publish the all-in now?" Silence. Then a nod. 2 months later, the fee sheet hits inboxes. A quarter after that, clean shares replace revenue sharing. Admin shows as $52 per head. The next rebid drops it to $44. None of this fixes the economy. It fixes your corner. Plan-level reforms turn one person's hard questions into policy that outlasts managers and slogans. When the bill is visible, it shrinks. When the votes are accountable, they move. When 10 people push together, the hinge turns. Shockproofing your timeline, managing sequence risk. Alicia can't time markets, but she can decide when her life has to sell into them. Sequence risk is timing risk with a calendar. Returns arrive randomly, bills arrive on schedule. The fix isn't clever funds, it's a clock, cash now, safe soon, growth later. So volatility hits charts, not rent. Start with buckets. Now, hold 6 to 12 months of core expenses in high-yield savings. It's not idle, it buys options. Soon holds 2 to 5 years of withdrawals in short treasuries and tips, low duration, some inflation link. Later is broad equities for 5+ years. The rule is simple. The closer the dollar is to dinner, the safer it has to be. Action in a drawdown. Markets fall 20%. Alicia keeps contributions flowing and rebalances only inside bands. Spending comes from now and soon, never from equities for at least 2 years. She sets bands at 5% drift and refills the near buckets after markets recover, not while they're falling. That delay is the edge. It turns panic into patience by design. Duration is a choice. Many glide paths lean long in bonds near retirement. That helped when rates fell. It hurt when rates reset. Alicia tilts soon to short duration treasuries and adds tips for part of it. She gives up a sliver of yield for fewer surprises. The goal isn't the highest coupon, it's spendable stability. A micro moment proves the point. Marcus, 2 years from retiring, built a 2-year buffer after his scare. During the next sell-off, he paid his bills from cash and short treasuries. His statement bled red. His checking account didn't. When markets recovered, he refilled the buffer from gains. The difference wasn't luck. It was a calendar. Now layer Social Security. Delaying to 70 materially raises the inflation-adjusted check. For average health, it's the cheapest annuity she'll ever buy. The bridge is the challenge. Buckets bridge it. Alicia models 2 paths. Claim early and invest the difference, or delay and draw from soon. With a modest part-time income and that buffer, delay usually wins on lifetime risk. Debt is sequence risk with interest. Variable rate cards and personal loans force sales when markets are down. Alicia prioritizes anything double-digit before chasing extra return. Killing a 19% balance is a guaranteed win that also shrinks the size of her now bucket. Fewer fixed payments mean fewer forced choices. Health costs trigger forced selling too. She treats her HSA as a deductible wallet first. Fund it, then spend it on real care. If the year is light, she saves receipts and lets some dollars grow. When open enrollment comes, she shops plans by worst case out of pocket she can actually cash flow, not just the premium. A lower catastrophe cap can be the better volatility hedge. Illiquids complicate rebalancing. If her plan includes private real assets, she caps exposure and assumes those marks are soft. In stress, the liquid sleeve bleeds to rebalance because the illiquid can't. Alicia writes a rule: illiquids never count in now or soon, and never push equities below the floor she needs for long-term growth. She builds a panic protocol: no allocation changes within 72 hours of scary headlines. Any change must be written, slept on, and reread. She texts it to a friend who agrees to sanity check. She widens rebalancing bands a notch in turbulence to reduce churn. She adds a fridge checklist for recessions: keep contributions steady unless job loss, freeze lifestyle creep, tax loss harvest and taxable, delay big discretionary buys 90 days. Sequence proofing is also cash flow proofing. Fixed costs are leverage against you. Alicia renegotiates a 2-year lease with a smaller first-year bump, switches phone plans, requotes insurance. The monthly delta goes half to her now bucket, half to a 1% contribution bump. The buffer grows without guessing markets. Finally, she writes it down, 1 page: target savings rate, bucket sizes, bond duration, tips share, rebalancing bands, fee ceiling, a liquid cap, social security target age, panic protocol. It lives in a cabinet, not a cloud. When volatility hits, she reads the page out loud. The plan steals drama from bad weeks and gives her what she really needs: time to wait for the market she already owned. The paradox explained: owning the system that charges you. Alicia keeps running into the same wall. She's both the customer paying the bill and the investor cheering the margin. It isn't a contradiction, it's the operating system. As a consumer, she wants cheaper rent, lower premiums, and fairer aisles. As a saver, even through simple index funds, she benefits when those same companies raise prices, cut costs, and defend spreads. Her statements and her receipts are telling the same story from opposite sides. Split her life into 2 ledgers. On one side, cash outflows, rent after taxes, premiums before breakfast, groceries every week, fees that don't blink. On the other, capital inflows, dividends and interest in taxable she can touch, and a bigger pool of growth inside accounts she can't touch for years. The paradox lives in timing and scale. Outflows are monthly and in cash. Inflows are future and often trapped. Even when they look equal on paper, $700 more in her account versus $700 more at the register, they're not the same dollars. Ownership through funds adds a third layer. Alicia doesn't walk into a boardroom. Intermediaries do. Her diversified exposure is real, but it's mediated by stewards who answer to basis points and flows. That distance blunts the power she thinks she has and preserves the pricing power she feels. Owning the market reduces single company risk. It also spreads accountability thin enough to drift. Here's the trap that tempts people: declare the system rigged and opt out. Cash, CDs, maybe a little gold. But skipping growth assets hands inflation the keys. Over 40 years, wages alone rarely outrun rent, healthcare, and staples. Without equities, her future earnings need to carry everything. That math breaks more households than it saves. Opting out hurts her. It doesn't lower the bill. So the question isn't whether to own. It's how to own while shrinking the harm to her present life. Change the goal. Stop chasing the highest account balance at 67 as if nothing else matters. Aim for the widest life margin across decades. Income plus portfolio growth minus the frictions she pays to live. She wants breathing room every month and enough compounding to buy time later. That's different than maximizing returns at any cost. It's maximizing room. With that lens, the paradox becomes a design problem. When she drives fees down, she isn't just collecting a yield. She's removing a permanent toll that erodes her life margin every year. When she trims fixed costs, she isn't just couponing. She's buying resilience so she can keep contributing when markets are ugly, the fuel for compounding. When she pushes her plan toward clean shares and visible admin, she isn't staging a protest. She's changing a rule that narrows the spread between what she saves and what leaks. It also reframes what she supports as an owner. She needs profitable companies to fund her future. She also needs competition that shows up on her receipt. That isn't a purity test. It's stewardship that admits consumers exist. Her plan can adopt proxy guidelines that weigh affordability where participants spend the most: rent, premiums, groceries, utilities, without pretending to run businesses from the ballot box. It can publish vote rationales when directors wave off proposals that would clarify renewal spreads, rebate pass-throughs, or shrinkflation. It can split mandates across 2 index providers in those sectors, so no single steward quietly sets every norm. None of that turns a truce into a price war overnight. It tells boards someone is watching the cash register, not just the cash flow statement. Alicia's choices at home line up with that posture. She favors the lowest cost broad indexes in her plan: total US, total international, total bond, because fewer layers mean fewer quiet tolls. She caps illiquids so her portfolio can move when she needs it. She writes a 1-page rule set: allocation, fee ceiling, rebalancing bands, panic protocol, and tapes it inside a cabinet because behavior pays better than cleverness. The plan level push runs in parallel. 1-page fee sheet, clean shares, QDIA fee cap, rebid cadence, sector-specific proxy guidelines with public vote rationales. Household and committee, same blueprint, visible bills, fewer tolls, clear rules. Then she sequences her influence. Alone, she's one account. In a plan, she's a block. 10 emails with the same list, publish all-in fees, clean shares by year-end, cap the QDIA, set a vote policy on consumer impact proposals, can move a provider that 1,000 private complaints never touch. She doesn't need victory speeches. She needs a memo that says, admin now billed, at $44 per head, and a proxy report that says, we supported renewal spread disclosure in metros where you live. Micro moments prove the paradox can be managed even if it can't be eliminated. Her rent renewal lands the same week her Staples ETF pays a dividend. The dividend reinvests for $63 inside a tax-deferred account. The rent climbs $140 in cash. She routes taxable dividends to her grocery budget for a quarter, then flips back. She calls the landlord and trades a longer term for a smaller first-year bump. She toggles off a managed account and drops 0.35% in overlays. She isn't trying to be right about markets. She's trying to be less wrong about cash. The universal owner debate will keep humming in white papers. Common ownership, competition, fiduciary scope, none of it resolves by next Tuesday. Alicia can't wait for consensus. She can measure what she can control: basis points cut, months of buffer funded, fixed costs lowered, QDIA fees capped, vote rationales published. She checks those 5 boxes every quarter before she looks at performance. Performance is weather. Design is architecture. 2 truths can sit next to each other without canceling out. Truth 1, her retirement needs profitable firms. Truth 2, some of those profits raise her bills. The honest response isn't denial or performative exits, it's design. Design her portfolio to be cheap, broad, and under her control. Design her budget to reduce how much pricing power can squeeze her. Design her plan's policy to treat consumer welfare as part of long-term value, not a press release. That's what turns ownership from a quiet tax into a loud advantage. She keeps the engine that outruns inflation. She strips the toll booths she doesn't need. She pushes her plan to vote like households exist. And she builds enough buffer that market storms hit charts, not rent. The paradox doesn't disappear. It shrinks until her ledger, not the systems, decides how she lives. The household ledger, your personal P&L against the market. Alicia clears the table, sets down a notebook, and draws 4 columns. Income in, capital in, costs out, tolls out. No dashboards, no colors, just her life on a page. Wages first, 2 paychecks, the small side shifts. Then any cash she can actually touch from investing, taxable dividends and interest. Not what reinvests in the 401k. What lands? On the other side, fixed costs, rent, premiums, utilities, car, transit. Below that, variable groceries, fuel, kid stuff, odds and ends. At the bottom, a line that rarely shows up anywhere official: tolls. Fund expenses. Record keeping in basis points translated into dollars. Managed account overlays. Credit card interest. The quiet schemes. She starts attributing pain. Rent ties to the real estate sleeve she saw earlier, renewal spreads and amenity fees. Healthcare ties to insurer/PBM, names sitting in her index funds and in the bonds sleeve. Groceries map to staples, processors, and retailers, common owners across the aisle. She isn't blaming, she's matching. If rent rose $160 a month, healthcare out-of-pocket rose $300 this year, and groceries climbed $40 a month. That's $2,280 in new outflow. Her taxable dividends and interest covered $420. The spread is $1,860. That spread is the enemy. Action means ranking by controllability. Rent sits first. Negotiate a longer term for a smaller first-year bump. Ask for fee waivers. Escalate to regional. Healthcare sits next. Choose the plan with the lowest worst-case out-of-pocket she can cash flow. Fund the HSA to expected spend and actually use it. Move routine visits to telehealth to avoid facility fees. Ask HR about a transparent pharmacy model. Groceries sits third. One warehouse run a month for staples. Unit pricing over promos. Batch cook. Set a no multi-buy unless unit math wins rule. She writes targets. Rent. Secure -$70 per month off the increase or cap it with a 2-year. Healthcare. Cap catastrophe by $500 and fund HSA $1,000. Groceries. Cut $60 per month via swaps and bulk. Total goal. Reclaim $2,000 over the next 12 months. It's a number she can visualize. Rent for a month, an emergency, breathing room. Now the plan tolls. She lists every account and fund with the fee next to it in basis points and in dollars at today's balance. Target date at 0.33% on $52,000, about $172. Underlying index options as a DIY 3-fund blend would be 0.05%, about $26. Record-keeping skim of 8 BPS via revenue sharing, another $41. Managed account overlay, toggled off. Visible tolls, $239. She sets a ceiling in ink. All in under 10 BPS on index sleeves. Admin billed per head if possible. She emails HR. Can you confirm per participant admin as dollars and whether any funds still pay revenue sharing to the record keeper? Asset location gets a line. Bonds and REITs live inside tax-advantaged. Broad equity index in taxable, where she can harvest losses and manage gains. Dividends in taxable switch to pay out for a quarter, routed to the grocery budget while she resets. Not perfect for taxes. Perfect for breathing. She sets a calendar reminder to flip back to reinvest in 3 months. Allocation rules need a sentence, not a seminar. Target 60-40 across all accounts. 5% bands. Rebalance with contributions first, so she's buying quietly while she sleeps. She writes the tickers for total US, total international, and total bond. She adds one line. If any fund's total cost, including overlays, runs over 0.1%, move to the core. Behavior gets its own box. Panic protocol. No allocation changes within 72 hours of scary headlines. Any change must be written, sleep on it, reread. She texts the rule to a friend who promises to read it back if she wavers. It's small. It's armor. Then she maps exposure to life. Utilities sit under a regulated monopoly. Her fund owns it. She puts usage on a diet. Weatherize off-peak laundry. Check the rate plan. Kids' after-school program doesn't map to a ticker. That's a pure choice. She audits value. It feels mundane. It compiles. A micromove pays fast. She calls the leasing office and asks for a 2-year with a smaller first-year bump in exchange for earlier notice and allowing a cosmetic upgrade at her expense that improves the unit. The first answer is no. She asks to escalate. A regional offers a 1-year with $70 off the increase if she signs by Friday. She takes it. That call frees $840 this year. She splits the win, raises her 401k contribution by 1%, and sets a $100 automated transfer to her now bucket. She also runs a back-of-envelope 10-year. If she claws back $2,000 this year, adds a 1% contribution bump, and trims 20 BPS off portfolio costs, what does that look like? $2,000 a year invested at a sober 5% real could sit near $25,000 in today's dollars after a decade. A 20 BPS fee cut on a $100,000 average balance is $200 a year. Call it $2,500 over 10 years before compounding. The 1% contribution bump starts around $600 the first year and grows with raises. None of these numbers headline a report. Together, they move a life. She makes an annual ritual called Ledger Day. Each spring, she prints the plan's fee sheet and holdings, lists the top 10 positions by dollars, and writes the household categories each touches: rent, premiums, groceries, utilities. She reads how the plan voted on proposals tied to renewal spreads, facility fee transparency, rebate pass-through, shrinkflation reporting, and pass-through timing when input costs fall. If the votes went with management every time, she sends one email: "We'd like sector-specific proxy guidelines that weigh consumer impact where participants spend and published vote rationales for these proposal types." It isn't a speech. It's a standard. She tapes a micro-wins checklist inside a cabinet: requote insurance, switch mobile plan, scrub subscriptions, warehouse club monthly, unit price audit, ask cash price on meds, confirm generic equivalents, review utility plan, adjust commuting costs, submit a rent escalator counter. She ticks 5 in a weekend and locks savings into 2 automations: half to the now bucket, half to her contribution rate. Then she writes a footer no app will ever show. What this adds up to: lower fixed costs mean steadier contributions. Steadier contributions mean more shares bought during downturns. Lower fees mean more of the rebound lands in her account. Simple allocations mean fewer mistakes. Plan policy wins: clean shares per head admin, fee caps, vote guidelines, scale to help coworkers who never send an email. The ledger isn't about guilt for owning the market. It's about making sure the market doesn't own her. She closes the notebook and sets next year's ledger day on the calendar. Same 4 columns. Same rules. It's her personal P&L against the market. This time, the numbers answer to her. Owning the engine that outruns inflation doesn't have to mean funding the tolls that squeeze your month, cut fees, shrink fixed bills, and force your plan to show its hand. If this helped you see the hidden ledger, subscribe and share it with one coworker who will ask HR for the all-in fee. Then watch the next episode on how your plan's votes touch your paycheck. Your timeline gets stronger when you act.